tobacco, one of the most lucrative industries in the history of capitalism. You'd be hard-pressed to find a better performing investment over the last century. But how long can it keep puffing out profits? Today, we're going to take a look at one of the largest tobacco companies in the world, the Altria Group. A single dollar invested in Altria in 1970 would have turned into $8,130 by 2025. That's with dividends reinvested, of course. This amounts to a total return of over 800,000% or 17.7% annually. Now, what's crazy is that in that same exact time, the smoking rate among US adults declined from 37.4% to 11.6%. Smoking rates continue to decline, yet these companies are more profitable than ever. Even if we take a look at more recent years, from 1990 to 2025, a $10,000 investment in Altria stock would now be worth over $1.15 million in total market value if you had reinvested dividends. But wait, here's the kicker. I just did the math, and you would be earning over $80,000 a year in annual dividends. So every year from now on, you would be earning 8 times your initial investment from dividends alone. And let's not forget the impacts of future dividend raises and the possibility of reinvesting these dividends too. Dividends play a massive role in the returns of Altria stock. It has turned the investment into a compounding machine for much of the past century. In fact, Altria is likely the best dividend stock of all time. If there is a so-called dividend king, it is Altria. So that brings us to today. Is Altria still a good investment in 2025? In today's video, I'm going to do a comprehensive review of the Altria Group stock that will include a look at their key financials, as well as understanding the actual business and operating companies that power it. I will also share my personal investment in MO stock and why it's a core part of my dividend growth portfolio. I'll show you what kind of dividend income it generates me right now. If you stick around to the end of the video, I'll evaluate whether the company is a good buy at current prices, why the stock has been going up lately, and I'll share a discounted cash flow valuation and a valuation using the dividend discount model. With that said, let's roll the intro and get into the analysis. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. As the great investor Warren Buffett says, you should never invest in a business you don't understand. So today I'm going to provide a full picture look at the business and stock history of the Altria Group, ticker symbol MO. Altria has a long and complex history dating all the way back to 1847. It was originally founded as Philip Morris, which went on to become one of the largest cigarette and tobacco manufacturing companies. It became publicly traded in 1938, and by 1972, their top brand Marlboro became the best-selling cigarette brand. Around this time, the tobacco business began to face huge political pressure. The health risks of cigarettes and tobacco became obvious despite arguments from big tobacco companies. Ultimately, the industry became heavily regulated, faced constant lawsuits, had its advertising ability banned, and encountered numerous anti-smoking public health campaigns. This caused cigarette smoking rates to decline from 42.4% of adults in 1965 to 11.6% in 2022. Additionally, the average number of cigarettes smoked per day among smokers decreased as well. Despite this, the tobacco business continued to financially grow as they raised prices to counteract falling usage. Although heavily tobacco reliant, Philip Morris & Co. was really just a holding company. They purchased and had ownership in many different businesses over the years. For example, they previously owned both Kraft Foods and the Miller Brewing Company. In 2003, the company rebranded from Philip Morris Companies to the Altria Group. The reasoning for this was to emphasize Altria being a holding company and begin to make a distinction between it and the tobacco-connotated Philip Morris. In 2006, Altria split off Philip Morris's international business, which is now traded under the ticker symbol PM. And if we look today, that company is valued at $239.9 billion. So Philip Morris International is actually more valuable than the Altria Group. In 2007, the Altria Group completed the spinoff of Kraft Foods. These two spinouts are very noticeable when we look at the earnings per share and dividends of Altria stock over time. For example, if we look at their dividend payment, you can see a drop-off in 2007 and in 2008. In 2007, Altria spun off their Kraft Foods ownership, and in 2008, they completed their spinoff of Philip Morris International. This is from the completion of those two spinouts. However, excluding those events, Altria has been increasing its dividend every single year for many, many decades. In recent years, Altria has made many investments trying to future-proof and diversify the company away from cigarettes. However, some were large failures, such as Juul, and others have had more promising results. So what does their business look like today? Their core focus is in adult consumers and primarily in nicotine-based products. That includes newer high-growth categories such as nicotine pouches. Altria owns the brand On. They also have some strategic investments in alcohol and cannabis. If we take a look at Altria's operating companies, their largest is Philip Morris USA. This is the cash cow of the company. They own the #1 cigarette brand in terms of market share, which is Marlboro at 41.7%. This has been the top-selling brand in the US for more than 45 years. Not only is it the most popular, but it is also priced at a premium relative to other brands. So you could think of this as the iPhone or Coca-Cola of cigarettes. And it's this which is the core cash cow of the company that really powers all of their dividend payments. They also have other brands like Basic, Benson & Hedges, L&M, Merit, Parliament, and Virginia Slims. They also own U.S. smokeless tobacco. This is an oral tobacco company, and they own top brands like Copenhagen and Skoal, and they are at 37.5% market share when you include a company I will be talking about a little bit later, which is On. That is a nicotine pouch, which they do include in the oral tobacco product, but I'll talk more about that in a bit. Their third operating company is John Middleton. This is one of the largest cigar companies. They own Black & Mild, as well as Middleton's Cherry Blend. They sell 1.8 billion sticks a year. They also sell pipe tobacco. But these three companies here are not growth businesses for Altria. They make a ton of profit and by far are the top profit contributors to the company. However, Altria does have two new growth businesses as well. That includes Helix Innovations. In 2019, they acquired 80% of this company, and then in 2020 and 2021, they completed the entire acquisition, and this gave them ownership of a product called On. This is a nicotine pouch product which has become incredibly popular. The average person probably knows Zyn, which is the top brand, but Altria has been able to increase the distribution for On, and it's become one of the top nicotine pouch brands. They have 8.3% market share, and just in the past year, they gained 1.5% of market share. And the reason why this is important is it's one of the fastest growing categories in this entire market segment. In 2023, Altria completed the acquisition of Enjoy Holdings, which is now known as Enjoy. This finally gives them full control of an e-vapor product that is FDA authorized. And Altria has been able to use their distribution to expand this product. And this is actually really interesting since I own some Altria stock. Every time I go to a gas station, I go and look behind the counter. And over the past year, I've noticed that Enjoy and On nicotine pouches are now at basically every gas station I go to. So they are expanding their product distribution. And they're able to do that so easily because Altria has all these relationships with their existing brands. They can leverage the weight of a product like Marlboro in order to get their other products into these stores. They also have a joint venture with JT Group for a heated tobacco stick product. They have a pretty large investment in Anheuser-Busch, which they recently started selling off over the past year, but it is one of their better assets on their balance sheet. And in 2019, they bought a 45% stake in the Kronos Group, which is a cannabis company, and this has kind of been a disaster. As you can see, their stock has done terrible, and they're now valued at $1 billion, but it's down 91% from its peak. Anheuser-Busch stock hasn't done that well, but the company is still very valuable and highly profitable. They have a $113 billion market cap. So let's take a look at Altria's business right now. Their largest segment is smokable products. That generated $17.7 billion of revenue after excise taxes. That was down 0.8% year over year. However, operating income came in at $10.8 billion, which was up 1.4%. And based on adjusted operating income, it was up 2% year over year. So again, this is their largest business segment by far. But I want to emphasize, this is not a growth business. Revenues have been flat and declining for a long time. The total shipments of their products continues to decline year after year. For example, their total cigarette volume declined 10.2% year over year. Even their most powerful product, Marlboro, is still declining 9% year over year. Now, what does the company do to combat this? They raise prices. This is what they've been doing for decades. They increase the prices on the products they sell, so they actually make the same or more money with declining volumes. And this has been going on for decades. And this actually works pretty well for them because Marlboro is in the premium segment. They have 59.4% market share of the premium segment. You also have to wonder if these continual price increases are part of why the volumes continue to decline. I'm sure they have people doing the math over at Altria to figure out the optimal price to volume ratio. So when you're analyzing this part of the business, which is the biggest and most profit producing part of their business, you have to put a very low multiple on it because it's not a growth company. It has a lot of profits it pays out to shareholders, but this is not likely to grow in the future. And definitely not at a high rate. Maybe you can squeeze out 1 to 2% growth. In 2024, in the full year 2024, that had $2.6 billion of revenue after taxes. That was up 4.5% year over year. So you can already tell this is a much smaller business, but it is still pretty profitable and it's growing better. Their adjusted operating income came in at $1.8 billion, which is up 5.2% year over year. And their adjusted margins are at 67.8%. So these are high margin products. And this oral tobacco category is a tale of two cities. You have the traditional tobacco products, Copenhagen and Skoal. Those are declining in volumes, the same as cigarettes. However, you have the new product entry on nicotine pouches. And as I mentioned, these are a growth product. In the past year, they increased volumes 40.2%. So what analysts are starting to realize is that 5 to 10 years from now, this will be one of the bigger companies in Altria's business. However, as I earlier mentioned, they have Enjoy, which is their other growth business. They increased shipment volume of their consumables 15.3% year over year, and the devices volume increased 22% year over year, and they grew market share by 2.8 points to 6.4%. Now you might say, Zach, what does this mean in terms of actual revenue? So with Enjoy, they're expecting to double their U.S. smoke-free revenue. And they don't always disclose all the details since that's a newer business, but they just put out their 2028 enterprise goals. And in that, they said that their goal is to double smoke-free net revenues to $5 billion. And they also mentioned a 2022 base of $2.6 billion. So that's where they're getting that from. So longer term, it's On and Enjoy, which are going to be the core growth businesses for Altria. But they also have goals of entering non-nicotine categories with broad commercial distribution of at least 5 different products by 2028. So that will be interesting to see what they announce with that longer term. They're planning to focus on the consumer needs of enhanced energy, focus, stress relief, and relaxation. So I read that and I'm thinking energy drinks and probably some kind of cannabis product. And this is interesting. I didn't know they did this. They made a minority investment in Proper Wild, which is a manufacturer of clean energy shots. And Altria is actually helping with distribution of their products. So that is the business of the Altria Group. So I wouldn't say it's a growth company, but it's definitely not a dying business either. And as we get into the stock analysis, it was being priced for a while like it was a dying business. So let's analyze the stock of Altria from the perspective of a long-term dividend investor. To do so, I'm going to be using the stock analysis tool over on dividenddata.com. The entire goal of this tool is to help you find better dividend stocks and then track your progression. If you want to join and follow along in my stock analysis, then sign up at dividenddata.com. Right now is a great time to join because we have a special March Madness sale where you get 50% off our annual membership. You can lock in that 50% discount for life. There is a 30-day money-back guarantee, so no risk in trying out the tool. The link is in the description and pinned comment of the video if you want to get this March Madness sale. So we have the Altria Group, ticker symbol MO. The current stock price is $57.95, and the company is currently valued at $97.9 billion. If we take a look at their stock price, you can see that they peaked in 2017 and since then sold off massively. And the reason why that happened is in 2017, they made the acquisition of Juul. And if we ask the AI analyst how that went, it will provide some details of how much of a financial disaster that was for the Altria Group. However, this provided a buying opportunity that I took advantage of to start my position in Altria. They acquired a 35% stake in Juul Labs for $12.8 billion. And strategically, that was the right move, but the company faced massive regulatory scrutiny. You probably remember this if you live in the US. And Altria ultimately wrote down almost the entirety of that investment, and now they've divested from the company entirely. So what that meant was continuous on-paper write-downs of that investment, and they basically lit $10 billion on fire. And as you can see, the stock price did terrible in that time, and it has only recently come out of that. If we take a look at the non-GAAP earnings per share for Altria, you can see that continued to grow over time, even during those write-downs. So the earning capacity of Altria's business was still strong. However, if we go over and look at the key financials, for something like net income as an example, this is based on GAAP accounting, which takes into account losses on investments. They also had a large Kronos Group write-down, which I mentioned earlier. So as you can see, every single time that happened, it looked like they had very large negative earnings. And if we go and look at fiscal 2019, fiscal 2020, fiscal 2021, and fiscal 2022, it was held down by those write-downs. Their earnings per share were not actually reflective of the earning capacity of the business. And it's that GAAP EPS number that PE ratio is based on, which many people use as their core valuation metric. However, if we go and look at the historic free cash flow per share for the Altria Group, you can see during that time, not only did it remain high, but it actually grew in recent years. Free cash flow is the ultimate measure of a company's cash generation. To help understand that, you have your cash from operations, which is basically all the cash the company generates after expenses. And then on top of that, you have capital expenditures, which is additional spending on equipment and infrastructure, those types of things. And then what's left over after that is your free cash flow. And this is the real measure of what a company could pay out and distribute to shareholders as something like dividends. And Altria is the ultimate dividend stock. So for years, if you were looking at the Altria Group stock, and let's say you went to go look at the payout ratio, by the way, all of this is available at dividenddata.com, the best tool to do so. Say we scroll down and look at the payout ratio. For years, it looked like the net income payout ratio, or based on GAAP EPS, was unsustainable from 2019 to 2022. So people on the surface thought the dividend was at risk of being cut. However, that was wrong, because if we go and look at the free cash flow payout ratio for Altria, which is a metric most websites don't have and most people don't look at, you can see it was sustainable for that entire period of time, around 77 to 81% free cash flow payout ratio. Now, it's still on the higher end, but let's remember Altria is an extremely mature company that just pays out most of their cash as dividends. They do that on purpose. So during that time, there were many opportunities where you could have bought Altria from anywhere from an 8 to 10% dividend yield. I used that as an opportunity to build my stake in the company. In fact, I bought a large chunk in 2023 to early 2024 at this 9.5% yield. And what's interesting is for stocks like Altria, people seem most interested in buying when they get down to these lower dividend yields. For example, last year, their GAAP EPS, so their net income, was just at a very high level because they had some investment gains and they sold some of their Anheuser-Busch stake. So that makes their PE ratio look really cheap. It also makes their net income payout ratio look super cheap at 60%. So the broader market is starting to realize that Altria is not at risk of cutting their dividend and is actually still a good dividend growth stock. The 5-year compound annual growth rate of the Altria dividend is 3.96%. Their most recent dividend increase was 4%, and the one prior was 4.26%, and they will likely continue increasing it at 4%. And as the market expects the yield on treasury bills to come down as the risk-free rate of return is lowered this year, longer term people are expecting lower interest rates in general. A high-yield stock like Altria starts to look compelling if you're looking for reliable income. And I think that's a big reason why Altria's stock price has been going up over the past year. And it was actually doing extremely well during this recent 2025 sell-off. People were looking to Altria for reliable income. Altria stock is up 8.6% over the past month, while the broader market indexes have sold off. It's up 29.8% over the past year. So it's interesting that people seem to be more interested in buying Altria now than they were over the past 5 years. And what I would argue is that it was far less risky to buy Altria stock when it was at a 9.5% dividend yield than today when it seems to be a more reliable 7%. If you're investing in the Altria Group, you really want to make sure you have a low entry point valuation for the stock. And the reason why is that this is not a high growth company. The majority of your return is going to come just from dividend reinvestment. The revenue per share is growing at 2.75% 10-year CAGR. Their free cash flow per share is growing at a 4.3% 5-year CAGR. And this company does generate a lot of cash and are in a strong position, but compared to big tech companies, they don't have the best balance sheet. They have $21.7 billion of net debt. This is a company where if you're going to buy it, you have to try and buy it cheap. And that's what I've done in my dividend growth stock portfolio. The Altria Group is my third largest position, currently valued at $32,300. I have a 62.7% total return. That's up $12.4 thousand. And this is my largest dividend payer as well. The company pays me $2,280 in annual dividends. And my overall yield on cost is 9.51%, but from reinvesting all of my earned dividends, my current yield on initial cost basis invested in the stock is 11.45%. And from reinvesting dividends, I've earned another 95 shares of Altria. This is the compounding effect of reinvesting dividends at work. That's another $387 they pay me every year, which is going to buy even more shares in the future, increasing my future income, creating a snowball effect. And on April 30th, they're about to pay me another $570 dividend. Altria is my largest dividend payer by far. They make up 48.67% of my total dividend income. And I'm okay with that. And I actually think I'm going to get a very good long-term total return on my Altria investment. But I bought the stock cheap. I mean, look at it. You see my yield on cost. Now, what I will say is that Altria is still probably one of the best 7% dividend yield stocks you can buy. But I'm not entirely sure it will beat the market on a long-term going forward basis from this price, especially not if it keeps going up. But that's just my initial opinion. I don't think the company is getting towards overvalued. If it goes up another 10 to 20%, then we're getting close. Right now, I would just say it's fairly valued. I would not say it's a steal. Well, let's verify this by doing a valuation on the company. Using my dividend data AI analyst, I did a discount cash flow valuation on the company. I also did a dividend discount model valuation on the company. Both are pretty interesting techniques that apply well to a company like the Altria Group. So here you can see the DCF valuation they gave. It gives it an implied share price of $60.15, which is 2.74% upside from the current price. But let's see how they calculated that. So this is assuming basically no revenue growth through 2029. I did just make some minor alterations. And by the way, you can edit all of these things over on dividenddata.com. Just type in any stock and DCF calculation, and you'll get this calculator that you can open up. And basically what this is all coming down to is changing the free cash flow projections in future years. And this is pretty conservative. It's basically staying around $10 billion a year. And then we have two different approaches we can do here. So this is what it defaulted to, doing a exit multiple of free cash flow. So basically what you expect the company to trade at in terms of free cash flow. And it used what it is today, which is 12.37. And based on that, it gives an implied share price of $62.16, which is 6% upside. However, you could also do it based on perpetuity. And this is where it starts to get a little different for Altria since it's such a low growth company. Assuming a terminal growth rate of 2.5% boosts the implied share price to $120. But even if we just put that at 1%, it puts the implied share price at $88. So 51% upside. Now, the lucky thing for investing in Altria is that it is a pretty cheap stock. So you're unlikely to lose a lot of money at current prices. However, in my opinion, I think an even more conservative and accurate way to do a valuation for the Altria Group is based on the dividend discount model, which is basically valuing the company only on their dividend payments. Here's the formula, by the way, for doing the dividend discount model. And basically, as we plug it in, we take the current annual dividend, which is $4.08, times 1 plus an expected dividend growth rate, which they assumed was 2%. I could ask the AI analyst to do this again, assuming a different growth rate, but 2% is pretty conservative, so I like that. And this is assuming an 8% cost of equity minus the growth rate of 2% again, which puts an implied share price of $69.36. So if your goal is an 8% return and you think there will be a 2% dividend growth rate, then the Altria Group stock is undervalued by around 18%. I asked for a little bit of a change though. I said do a DDM valuation again for MO, but change the cost of equity to 10% and growth rate of dividend to 4%. And with these changes, which I think are more accurate, it gives an implied share price of $70.72. So overall, I would say Altria stock is still pretty attractive at a 7% dividend yield. It is definitely one of the better high yield dividend stocks you can buy, even after going up recently. And it will continue to be a core part of my dividend growth stock portfolio. However, I will give two warnings. You do not want to be chasing the Altria Group stock whenever it goes up in valuation significantly. do not chase this stock. And my second warning is one that I give all the time, which is you should always do your own research before making any investing decisions. Don't take my opinion or any of the analysis I just shared as the gospel. I'm just sharing my personal thoughts and opinions. The markets can change a lot. Business conditions change a lot. So you should form your own opinion and reevaluate that consistently. If you want to use any of the tools I showed today, all of it is available at dividenddata.com. That includes these valuation calculations. I do think dividend discount model is a great one for these high yield companies. And right now is a great time to join because you can get 50% off our annual membership. This is part of the March Madness sale. It's only going to last for a limited time. So if you want to get access to that, click the link in the description and pinned comment of the video. If the tool helps you find just one better investment, then it way more than pays for itself. Again, link in the description and pinned comment. And with that, I will see you in the next video. Thanks for watching.